Hi, I'm Joel Fadley. Again, I'm the chair of accountancy here at East Tennessee State University. I spent about 33 plus years in business and various jobs, from IT, programming analysis, over into corporate finance, accounting manager, and controller. So I have a varied background, even some HR, some operations along the way. Continuing on with the boot camp here with these short videos I'll put together. We're going to look at generally accepted accounting principles. And let me share that screen here, wherever it went. Here, accounting principles and guidelines. What I have here on the screen are 12. Some of them are assumptions, as you can see here. Some are principles. Some are just things that we do that is just built into the thinking of an accountant. I use this in my major level classes that I teach, and also my Master of Accountancy course. But this is something that business leaders need to understand. This is GAAP, G-A-A-P. This is what drives American business accounting systems, because it's based on the accrual basis of accounting, not cash basis. No one cares about cash basis is the IRS and smaller mom and pop operations. They may keep their books on a cash basis, but we have to use what's called the accrual basis, ACCRUAL. There's several principles on here. The 7 cases that you're going to be researching and writing about are related to number 8, revenue recognition with WorldCom. We've got the matching principle there with waste management. Materiality is a company called Auto Parts Store. Conservatism and consistency, that's something that is a part of about any case that you would look at. Now, the others up here at the top that I have, 1 through 7, full disclosure, that's going to be an important part of the materiality case as well, although I don't specifically refer to that here like I would in the case. The measurement principles, that cost principle, whatever you paid for an item, that's considered the cost principle. Fair value, in some cases, more relevant than historical cost. For purpose of this class, fair value is usually, if it's less than the cost, then you write whatever you have on your books as an asset down. One of the things that accountants and the financial function and you as a business leader need to understand is you're always concerned about assets being overstated, right? Assets, what you possess. You don't want that to be overstated. Oftentimes, that's what auditors will look at first. They will want to verify that the assets that you have on your books are accurate. They're not inflated. That if something has gone down in value, then it needs to be reflected. We have a case with waste management, even though that's about the expense or matching principle. It also touches on this particular principle because waste management has all these landfills. Well, land typically goes up in value. And if it goes up in value, you don't write that asset up. If you paid $100,000 for some land and 40 years later it's worth $1 million, it's still on your books as $100,000 because of conservatism. Well, if you're like waste management who has these landfills that the land goes down in value, then they should do what's called impair the land and write it down to fair value. So it's really the lower cost or fair value, the lower. That's conservatism because you never want to mislead investors. That's the whole point of having GAAP. That's the whole point of having the SEC, making sure that companies are following this so that earnings and financial positions aren't exaggerated. Going concern is always important, that the company is going to stay in business in the future. We really don't get into that much in this particular class. Time period assumption. There's usually either monthly closings, quarterly closings, and annual closings. Monetary unit, economic entity assumption. Those are pretty straightforward. So the ones we really focus on here in this class are really number 8, number 9, number 5, number 6, number 7, 8, 9, and 10. So those are very important principles. Let me pull up the actual content for this course. And just briefly go through it. There's actually 4 modules in this class, not just the boot camp, but the actual ACCT, as you see up here at the top, ACCT 5150. The first module is about revenue recognition. And this is the WorldCom case. This is Bernie Evers. He's being let off to prison because of inflating revenue, booking revenue that didn't exist. Very simple case. And this was something that happened back, I'm not sure if it's the early 2000s or late 90s. A lot of stuff like that was going on back during those days. So this is a great case that students usually like to read about because it is sort of exciting to read about people who do things illegal and they go to prison and find out what they should have done right, what you should as business leaders be aware of to be on the lookout for as a CEO or as a general manager of what can go on in a financial function. And of course, we have some accounting undergrad majors in this as well that very, very much aware of some of these cases. So the WorldCom revenue fraud, a lot of good information here. Big 5 accounting firm taken down with Enron. We don't touch on Enron in this class, but that's another case where Arthur Andersen and Enron both went down the tubes in early 2000s. WorldCom also, in addition to revenue recognition, they had issues with CapEx. They were capitalizing things that should have been expensed. And that's always easy to move if you remember back to that particular accounting concepts here. And there it is again. If something's being capitalized that should be expensed, you're actually taking it by credit to expense and you're debiting the asset. So in essence, you're taking it off your income statement, putting it on your balance sheet. That's always trick in the book of fraud, of trying to boost earnings, because if you're reducing expenses by credit and you're putting it back on your balance sheet as a debit, you've understated your expense, so you've overstated income, and you've overstated your what? Your assets, which again, rule 1 is don't overstate your assets, right? All right, so back to this module here with WorldCom. Very simple what they did. A couple of things there with revenue and with expense to boost their guidance. You think, well, why do they do that? Well, it's all about earnings per share as the stock market. What drives the stock price? I mean, that's always, how can you make your stock price continue to go up? And it was something that was unfortunate, but it still goes on today, maybe not to the extent as it did back in late 90s and early 2000s. But here, there's the fraud triangle. Fraud, where you have 3 things. If you have opportunity, if somebody's motivated, then they're going to rationalize why they're going to commit fraud. You see it all the time. You see it in these small nonprofits where somebody has gotten caught for stealing $30,000 from a church or some other small nonprofit because nobody's paying attention. The opportunity's there when there's not a segregation of functions, one person doing too much. They're motivated, right? They rationalize that, well, maybe I'm underpaid. I know what the executive director makes, and I don't make anything or I make a lot less. So they rationalize why it's okay to cheat and steal. So that fraud triangle is very much something that should be considered whenever you're setting up internal controls. That's what we'll talk about here in one of these other cases. So that's the first case. The next case is, I think it's probably module 2. No, there's the next case, waste management with fraud. Of course, fraud applies to both these first 2 cases, but the second case on expense is waste management. So I just talked about with the with the impairment of the landfills. But waste management as well was extending the life of the assets to where they were spreading depreciation out from maybe instead of 10 years, they were spreading out to 15 years, right? So anytime you're going to spread out the cost of an asset and allocate as depreciation, the further you spread it out, the more you're going to want. You're going to raise net income over that period of time. which is what they were trying to do. So that's the second case we'll look at. WorldCom with revenue recognition is the first one. The second one is waste management with how they played the game with understating expense. The second module has to do with materiality and auditing. It's the auto parts case of a company with considering whether or not they should expense spare parts purchases or putting on the books as an inventory, and then expensing it as it is actually used. So that's the third case. We even go into the purchase to payable cycle, something that those of you who work in procurement and supply chain logistics will find interesting. We've got some different accounting pronouncements out there to read about. We talk about outsourcing because the fourth case is about Sunset Medical and a company that gave over much of the control of their business to this firm that they paid to come in and make a lot of changes that they shouldn't have made. A lot of conflicts of interest, nepotism, a lot of the soft side of things, how you manage your operation and how the accounting side and financials are intertwined with that. They dovetail together. So that's going to be our fourth case. Our fifth case is the anonymous caller. And I think that is probably in module 3. And this is about someone who goes to their former college professor and asks them about some stuff going on in the company they work for that is outright fraud. Very interesting case that you're going to enjoy reading about. And again, I pretty much guide you through each of these scenarios here of what's important, what you should do if you find yourself in this situation, because it's not always clear exactly what you should do. So there is room here for personal opinion, but it should be based on something that's solid. And so we've got several links in here that you're going to read and find out about. The Whistleblower Act that is now out there for people to protect them if they blow the whistle so they don't incur retaliation. Tone at the top versus tune in the middle. Very interesting case. Our sixth case is one on internal control. And that's probably in our last module 4. And what we have here is a couple that has a man and his husband and wife that had purchased an inn and a cafe, but they live many hours away. So they were trying to make sure they have controls in place that allows someone there to do pretty much 95% of the work. How are they going to control that when they're not there to see what's going on? How do they keep people from stealing? And so this gives you an opportunity to really use your creative side and come up with some internal controls that will make sure this business that they purchase can operate without fear of losing everything they've invested in it. So really good case. And then the final case is Global Dental. And this is about variance analysis, more specifically about flexible budgeting. It's really about cost behavior, about fixed and variable costs. And you'll put together a small flexible budget. And it's very important that you learn how to do this because every place I've worked for uses flex budgets. And what flex budget is says, well, if I got a 10% drop in revenue or a 10% increase in revenue, even after I have a budget finalized, how are you going to flex that budget to use it as a tool to manage and control your business? And that's what this section is about. Really good case. So that is pretty much sort of an overview of this ACCT 5150. Now, this is a boot camp video, but this is sort of an overview of what you're going to encounter when you get to this class, which is probably going to be the first course that you take as far as financial related. So after you take this, you'll probably take the finance class after that. But that's just an overview of what to expect. I'll see you soon.